A reset for the household consumer, a rethink for tech investors, and a vulnerable market, really just trying to make sense of it all. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Shonali Bassick. We're kicking you off to the closing bell here in the United States. Let's get a quick check on the markets and where we stand, because we are still down on the day. The S&P 500 down more than half of 1%. The NASDAQ 100 still down 1%. The SOX Semiconductor Index taking the brunt of the pain there. Most of the stocks there in the red on the day, including NVIDIA, which we'll talk about more, down more than 1.6% on the day so far, and the two-year yield hanging out just above 460. We had a bit in the bond market here, Romaine, but that bid is losing a little bit of steam.
Yeah, a lot to talk about today. Potentially a big week for fundamental market catalysts in this holiday shortened week here. And well, this could potentially be big earnings that we're going to get out of some of the most important retailers. That's going to cross the wire this week, and earnings from the most important tech company, that's going to hit the tape as well. Walmart did kick off the retail phase of the earnings season with a big beat for the past quarter, but soft guidance for the year forward. While Walmart has grabbed market share as U.S. consumers trade down to cheaper products, that trade, it's causing Walmart to express caution about how that rotation shakes out. Concern about consumer spending is evidence in, well, the results that we got out of Home Depot this morning. Those results this morning showed a fifth straight decline in comp sales. And while that 3.5% drop was in line with Wall Street, as well as a report last week from the Commerce Department, Home Depot's guidance for a 1% sales decline for the full year, well, that came in below analysts estimated. We want to sort of wait until next week before we get some of the other big box retailers, as well as some of those department stores, to see whether this is a Home Depot story or whether this is a broader story of everyone feeling the pinch. We do get reports over the next couple of days from Etsy, Five9, Wayfair, Floor & Decor. That is going to have to tide us over until then. But while the read on consumer spending is a big focus for investors, so too is the read on the AI hype. The spirit horse of the AI frenzy, NVIDIA, set to report its results tomorrow, a key driver of market gains for the past year. But Shonali, a big question here is how much sway are they going to have over a market that seems, at least over the last few sessions, seems to be de-risking?
The bears are certainly out to play, Romaine, but there are some bulls under the surface. I want to show you just how many there are. NVIDIA today, one of the biggest losers in that Philadelphia Semiconductor Index, but the options market tells you a very different story than the spot market does today. It is one of the top companies favored by options traders when you're looking at volumes relative to cash volumes. And much of this open interest is tied to call options with strike prices over $1,000. And that means the stock could have to surge over 33% for those contracts to pay off. Hopes for more gains are still under the surface, Romaine.
Obviously a big growth story there, a growth story that, well, maybe has gotten a little bit ahead of valuations. David Sauer will be joining us right now to help kick things off to the close, Managing Director and Portfolio Manager at Ancora Advisors. And David, I do want to start off with the earnings season. I mean, we're pretty much through the meat of it. We've seen some of the biggest companies, Sands and NVIDIA and a couple of others. But overall, have you been encouraged by what we've seen so far this season?
Better than expectations, Romaine. No great inflation here, but I'd give it a solid B, particularly if you look past just earnings per share and look at the dividend growth, and even more important, the growth in cash flow, free cash flow. We're likely to see double-digit free cash flow growth this year, as high as 15%, still very favorable 12 to 13% free cash flow margins, and the ability to buy stocks with an even better margin behind their valuation story. So I think the fourth quarter earnings season has been a solid B when expectations were a little more muted.
This gets, though, to a broader question, David, that I think everyone has on their mind, and that's really how much more of a runway does the broader market at least have to go, given the fact that we've already booked some relatively large gains just to start the year, and we don't even need to talk about the big gains that we saw in 2023 here. Do you see any real hope on the horizon for the next few months that we could see a material upside to the broader market?
If you ask me, by year end, I think there'll be still more upside. Just take the S&P 500 equal weighted. Since the end of 2021, it's up barely more than 2%. So the market had a great run last year, but that was a lot of catch up from the negative 2022. So I think there's more room to go. We saw last November 1st that investor sentiment got unusually bearish. After that, as a buy signal for the market in a 12-month period usually rallies 23% or higher. We're about 18% into this rally off the November lows. So it suggests to me there's more to go higher. It's going to be a grind. And always the rule of thumb, in any intra year, you're going to get about a 10 to 14% sell off. Be ready for it and look at what stocks are more attractively priced out of it that you can buy then that may be a little more expensive today.
David, given how far we've come with the tech-heavy indices, when you think about the NASDAQ 100, the Philadelphia Semiconductor Index, do you think that those indices, given how far we've come, could see greater drawdowns?
My experience tells me that even here in the first 6 weeks of 2024, that half of the S&P index gains have come from, again, just a handful of stocks. And this can persist for the next few months, but eventually, I think greater breadth, greater participation rates will prevail. The Mag 7 are certainly very enviable companies, but if you start to look forward on their earnings growth, their cash flow growth, how their CapEx spending on AI is beginning to pick up, those aren't red flags, but I think they're at least yellow flags for if they continue to be the leaders in the market versus what I think most active investors are rooting for, which is greater breadth, greater participation, and not just 5 to 7 stocks driving the index.
Well, you see that
it will rotate.
You see that in the periodical bid. You see in the Russell 2000 as well. You saw that really get hard hit when we saw the inflation data, for example, most recently. Do you think that betting on those small to mid-cap stocks will be a painful trade until what you say is true, that 6 or so months from now, there will be more breadth in the market?
I think you have to be there earlier than waiting for the move to happen. Small cap stocks have only traded this discounted to their large cap siblings about 10% of the time for the last 30 years. The median earnings growth for small cap companies is expected to be up 7 to 8%. I think you can find plenty of opportunities where on the margin, rebalancing can take place more into small cap stocks with a little bit of a value tilt versus continuing to chase that momentum, which is still prevailing the first 6 weeks of this year.
Yeah, absolutely. And that gets us to the question, though, too, David, about how you sort of discern value in this environment. I know there are the traditional metrics that we all rely on, or maybe a better phrase to say that most of us have ignored for the last big bull market cycle. But is this sort of that time where I think people really do start to gravitate back to that fundamental story?
I think they do. That valuation, as it has for 50 years, Romaine, will matter and matter even more. And it's less of a Wall Street vote, the way Wall Street tends to focus on price to earnings. You and I have had plenty of conversation. I prefer to look at the cash flow statement, free cash flow in particular. I can find companies that are generating free cash flow yields, even in a fast-growing tech area, of 5% or better. And that correlates to a 2 to 3 year annualized return in stocks of 8 to 9%. Throw in the dividend, and I think you're into a low double-digit potential rate of return if you buy the right stocks on valuation.
Yeah, absolutely. And well said. And we should point out our team over at Bloomberg Intelligence, they've been crunching the numbers all earnings season, David, and you're spot on when it comes to the cash flow story. David Sowerby, Managing Director and Portfolio Manager over at Ancora Advisors, helping us to kick you off to the close on this Tuesday afternoon, a holiday shortened week, but no shortage of big market moving events. Shares of Walmart right now trading at a record high. This after the retailer's sales and profits beat Wall Street expectations. A closer look at those results and what it says about the strength of the U.S. consumer.
Plus, in our stock of the hour, we look at ConAgra Brands. The company saying its frozen meals and snack businesses are well positioned. Consumers are using more of those GLP-1 drugs for weight loss, Romaine.
And one of the most active days for M&A, and well, regulators already flapping their gums about it. Capital One's deal to buy Discover for $35 billion. Investors like it, the regulators don't. We're going to take a look at a closer look at the issues being raised by this takeover. All that and more coming up in just a bit. This is The Close on Bloomberg.
$1.4 trillion U.S. junk bond market is getting junkier. According to the latest data from Bloomberg and Barclays, the share of double B-rated bonds in the benchmark corporate high-yield bond index has declined, while the share of riskier B-rated bonds has risen. This B-rated tier of debt is in the middle of the junk spectrum, and it's been on the rise since 2021. And for more insight on what it means for investors, let's bring in Bloomberg News credit reporter Olivia Raymond. When you look at the quality of debt that's out there right now, a lot of people have been pouring right into debt, and junk debt in particular. Is it riskier than it may seem?
Well, the index itself is getting lower quality. It's eroding in credit quality, so that inherently makes it riskier. When I talk to my sources, it's interesting. They believe that they're being compensated with the high yield, though. So you have to always remember that there is a downside risk in this market. It is a super risky market. There are chances that there are going to be defaults, and in a smaller credit universe, that chance is going to go up. But investors are still piling in. They love junk bonds.
They love junk bonds. They love the returns, right?
Yeah.
But you're saying that basically right now the risk reward, at least in their perception, is still in balance?
It's still in balance in their perception,
right.
But it's really interesting to sort of analyze, because if you look at spreads on a 5-year average, on a 10-year average, they're way below that.
Right.
So there really isn't much compensation on the spread level. It's all coming from the yield.
How do you know that they are protected against any risk of default at this point here? This is all assumes some brighter outlook for the economy. But if more and more companies are facing risk of downgrade, doesn't that seem to say the opposite?
There's definitely a risk that defaults could move higher, and I think it's something that investors need to consider. They're investing in a riskier market now. But
riskier relative to what? Because I mean, when you talk to some of these people, and obviously they have a long bias here, but the idea is that we're nowhere near sort of those sort of blow up stages that we saw, either whether you want to compare it to the global financial crisis or anything else here. So what is the fear?
I don't think there is a lot of fear in the junk bond market right now, and I think that's why we're seeing spreads tighter. To Shonali's point, yes, there is a chance that defaults could go higher, but my sources are not too concerned about it right now. They say the risk is contained.
Well, it's interesting. This all comes as you're seeing high-grade bonds also being issued at a rapid clip. You're seeing about $50 billion of corporate debt sales just this week, a lot of that tied to M&A. Are the spreads here looking commensurate to what investors really want to be getting out of fixed income right now?
When you think about the M&A pipeline, especially for investment grade, you would think that all that supply that's coming and all the supply that we have seen would push spreads wider. But in fact, Bank of America actually had a report out today saying that they think because of demand that spreads can move tighter. So you would think, given all that we're saying, that yes, there's a risk that spreads would widen, that defaults would go up, but it's just not being priced into the market.
Is the market as big as it used to be? Is it getting back to where it used to be?
It's actually getting smaller, Romaine. So you have companies like Ford, Kraft Heinz, Occidental Petroleum. They were all downgraded into junk in 2020 during the pandemic. They've all left. They're back in investment grade now. So you have some of the healthiest, strongest companies that were sort of propping the junk bond market up a little bit. They're no longer there anymore. Yeah,
we just showed that graphic there. Quite a few upgrades that we've seen over the last couple of months, which surprised me. But when you look at the rationale that some of the ratings companies had, I guess it kind of makes sense, at least for Ford, certainly for Occidental. I don't know. I can't make sense of Kraft Heinz. Olivia, great to catch up with you. Olivia Raymond, who covers credit for us. And Shonali, I was looking, every morning I look at, we put on the terminal to upgrades, downgrades in the credit space here. And consistently, really, for the last, 3 or 4 months, we've seen that balance really favoring the upgrade side of the equation.
Yeah, and it shows you that things are getting easier and better out there, but are investors really getting compensated? What's fascinating here is a lot of this investment grade issuance for M&A is coming in the form of investment grade issuance, not leverage loan issuance. And so investors are clamoring for some risk out there.
It's interesting, though, too, because we talk about, we're going to talk a little bit later in the show, whether we are seeing a material uptick in M&A and whether that uptick is going to include some of the, lower quality names, if you will, rather than just those sort of pristine investment grade names.
It depends on how quickly they can bring that cost of borrowing down, isn't it? And it's showing you they can do it without the Fed being on their side.
Absolutely. Here. All right, stick with us here. Just about 45 minutes until we get to the closing bell. Shonali and I are going to march down to those bills with a look at one of the best performing stocks of the day. That's Walmart. The sales topping estimates in the most recent quarter, a recap of the results, and more insight on that deal to buy TV maker Vizio. That's coming up next on The Close. This is Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And let's start with the airlines. Deutsche Bank actually seeing some bright spots for domestic travel out there, upgrading Southwest along with JetBlue and Alaska to buy from hold. The analyst Michael Lindbergh says carriers like Southwest well positioned to benefit as domestic capacity comes more into balance with demand, which in turn should aid pricing power and revenue. Shares of Southwest up fractionally on the day. Next up, let's take a look at Caterpillar. A downgrade today to inline from outperform. This over at Evercore ISI. The call more reflective of the broader machinery sector than it is to specific companies. But the analyst says it's probably wise to take some profits given the, quote, lower quality year-to-date gains from stocks like Caterpillar. Shares of Caterpillar given back today by about 2%. And finally, Walmart. Truist Securities maintaining the hold rating. This after the retailer's comp sales and profit beat street expectations in the most recent quarter. Analyst Scott Ciccarelli says Walmart has substantial momentum and will continue to perform well, but the hold rating does reflect some concerns about disinflation, particularly in that grocery business, as well as continued volatility on the margin side. Nevertheless, shares of Walmart up about 3%, 175.85. It's going to be a record high if it holds at those levels. And those are some of our top calls. We do want to stay in the sell side space and stay with Walmart to unpack its results just a little bit more. Scott Ciccarelli joining us right now, the man behind the call we were just mentioning, managing director and senior equity research analyst at Truist Securities. Scott, I was going through these earnings. I mean, it looked pretty good. I mean, volume was up. I know they came down a little bit on prices to sort of maintain consumers, but they made up for some of that by also keeping their costs in check. How do you really grade this most recent quarter?
Look, I mean, you've got to give them B plus, A minus. I mean, it's got to be somewhere in that range. At the end of the day, Wall Street is what? It's based on expectations, right? And how do you perform relative to those expectations? And if we're talking about pure fundamentals, these guys are doing great. They're taking market share from virtually every other class of trade. And, they've been putting up very solid comp growth. Margins are expanding. Like, you really can't criticize that. I guess the concerns would be really two or threefold. Number one, you do have some margin volatility, and they've shown that. Third quarter margins compressed when people weren't expecting that. You do have some disinflation pressures, certainly in food, and we're seeing that in some other areas. And then just the valuation, as you pointed out, stocks hitting an all-time high. And quite frankly, we feel like we missed the stock, and we're looking for a more constructive, opportunity to get involved in it on the long side.
Yeah.
But sitting here, I feel like the risk reward is a little bit more balanced, and I think the action in the stock for a good quarter probably tells you that.
Well, certainly a very well-run company, as it has been for years, Scott. But as you know, of course, there is a lot of hand-wringing right now about the health of the consumer. And while that may be benefiting Walmart in the short term, the CFO did raise this issue on the conference call, saying that there were some concerns, some caution going forward with regards to whether people were going to continue spending at the same level.
Yeah, look, I think everyone's got the same general mindset. And we also saw Home Depot report today as well. And I think everyone's kind of calling it's an engaged, resilient consumer. I think the fears that we had probably 12 months ago, did not really play out. We did not go into a hard landing type recession. But people do want value, right? And so whether it's, getting value in the home improvement sector at a Walmart, at Home Depot, or at Walmart, Costco is another big value player. Like, people are spending money, but they want to make sure they're extracting value for those dollars. And I would tell you, we've written a tremendous amount on the subject, and we think it's really being driven by strong consumer balance sheets. You've seen tremendous deleveraging by the average consumer over the last 10, 12 years. You've had asset inflation in stocks and homes, et cetera. And so the consumer in general is in a pretty good spot, especially when you wrap in a very strong employment cycle.
When you think about Walmart also, in addition to the earnings, you did have them also make this deal announcement today. It's a small company in the scope of things here, Scott. Right. But what does it really do for Walmart to be spending billions of dollars in this way? Does it really move the needle?
Not initially, of course. It's just too small, and Walmart's obviously a behemoth. That being said, they're not thinking about this as a hardware play, okay? This is all about this advertising business that they are building. The margins in the advertising business are tremendous, and it's another way, another vehicle for streaming of content that they can get their products, their vendor products in front of people, and people are willing to pay for that. And I think that's what the decision on Vizio is.
And as we're sitting here today on a day where Walmart is trading at a record high, what type of strategic moves does this position Walmart for the future? If you think about the next leg of growth for the company, where is the valuation going to be justified the most?
So, I mean, they've done a couple things, and honestly, some of this is right out of the Amazon playbook, right? They don't necessarily have an AWS division, but they do have a rapidly growing advertising division. They do have 3P fulfillment network, giving independent sellers another place that they can go with their products to sell, just like they sell through Amazon. So I think they're going to continue to seek any other kind of avenue that will allow them to help subsidize some of the retail business that obviously they're the biggest retailer in the country, in the world. So again, they're looking for other profit drivers, higher margin than what they can get from the core retail business.
All right, Scott, great to talk to you. Scott Ciccarelli over at Truist, a hold on Walmart. A closer look at the quarter, a relatively decent quarter, some caution in that guidance. Nevertheless, here, investors seem to like what they heard. The stock having its best day in about a year, and now it's Shanali trading at a record high. As you know, I am a man of the people, so I spend a lot of time in Walmart. Actually, I've never even really been in a Walmart. I've been in Walmart, I think, 3 times, and once was just to use the bathroom. But we talk about just the juggernaut that it is, and the idea that it really has a hold, not only on sort of the lower income spectrum, but even on the higher income spectrum. And they talked about that on the call, how a lot of their business, a lot of their growth is now coming from folks who make $100,000 a year or more.
It's incredible. There was a recent study that came out that showed you in the tax bracket that goes up to $145,000. Most people still make under $80,000. So it begs the question of what is happening with the lower end of the consumer and what is the ripple effect into these larger cap stocks if they keep on going upstream. You see the same thing with Capital One Discover.
Yeah, I do wonder, though, because we talk about sort of the health of the consumer. It's easy to say, okay, people are trading down, but at some point the trade down becomes not buying at all. And you saw a little bit of that hesitation on the conference call where they started talking about the longer term picture and whether that would be something. I don't know. I mean, they've held it pretty well in past recessions, but I mean, who knows?
And it's incredible. A lot of those retail sales data came out after the quarter. We have to remember that when we take these earnings into consideration.
Yeah, good point here. And you just happened to mention the Capital One deal, Discover deal. We are going to focus a lot on M&A when we come back from the break. Maybe this is the break in that drought in M&A deals. Capital One buying Discover Financial, and what's going to rank as the biggest merger globally so far this year. And we should point out, opposition to it is already being made vocal. A full breakdown when we come back after the break. This is The Close on Bloomberg. Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Shanali Bassick. Romaine, we have a lot to talk about today.
Yeah, I mean, we could talk about, I guess, some of the moves we're seeing in the equity market overall, which is to the downside. But I think what everybody really wants to talk about is Merger Monday. I mean, it's Tuesday, but we'll take it. I mean, considering yesterday was a holiday here in the U.S., but we did get that word yesterday about what is going to be, if it's successful, one of the biggest deals we've seen in quite some time.
Yeah, and certainly people working through the holiday, but at least it is for making some money back in those investment banks.
You see it there right on your screen. Capital One up 0.6%, Discover up 13%. A story first reported by Bloomberg that Capital One agreeing to buy Discovery Financial for a whopping $35 billion, an all-stock deal, and together the consumer finance brands would become the biggest lender by U.S. credit card loan volume. The proposal already generating some lawmaker pushback. Joining us for more is Bloomberg's Matthew Monks, who helped to break this story. Matt, great to have you here. And let's talk about the reason why this tie-up.
It's all about the network. It's all about the rails. Okay, so Discover is the fourth credit card network in the United States. It's the smallest. It's basically a minnow. I think it has 550 billion network volume in the U.S. That compares to 7 trillion versus Visa, about twice as much, 1.6 trillion for American Express. It really is a small company. Capital One, like he said in the conference call today, the holy grail for him is to be an issuer with a network. These networks are crown jewels. They're incredibly rare, even if they're really small. So you just put them together, and Capital One is going to be one of 2 vertically integrated credit card issuers and payment payment networks in the United States, along with Amex.
It's interesting to the point that Romaine was making pushback already. Senator Elizabeth Warren saying it would increase fees and credit costs for Americans. But presumably, this is coming out just really weeks after you saw regulators bring out new guidelines for bank mergers. Did the companies take that all into consideration, knowing that they probably would get regulatory approval? Or is there going to be pushback all the way?
So there are two types of regulators that we have to think about here, right? We have to think about their primary overseers, the Federal Reserve, the OCC, and then the FDIC. And then we have to think about the antitrust regulators, the DOJ and the FTC. Now, I can almost guarantee you, and Fairbanks even nodded at this in the call today, that they already kind of talked to the Federal Reserve and the OCC about this. They do something that's called like the nod and wink. You know, you don't do anything without your regulators being privy to it. Yeah. And they will kind of give you positive body language. We just know this. I just know this, right? Now, the DOJ and the FTC, that's a political matter, right? And there is more political sway there. That said, you know, we have shown in history, if you are willing to fight, if you are willing to litigate, there's a good chance that you're going to get it through. Microsoft and Activision Blizzard being a case in point.
Yeah, this is a much different animal, though, right? I mean, we talk about the size disparity. I'm also curious about this idea of how many banks, traditional banks or traditional finance companies, even want to chase down this road here. Is there a certain market here for whatever this tie-up ends up looking like for Capital One and Discover that kind of, I guess, gives them, I guess, a huge swath of the landscape, whether they want it or not?
Yeah, so Capital One doesn't have a network, a credit card network.
Yeah.
You know, they don't have the infrastructure. So nothing is changing. It's still going to exist. They're just going to take their credit card stuff and just put it onto that network, which is going to make, ideally, and this is if you believe their story, Discover a healthier, a stronger, and a better competitor to the top three.
Why am I to believe that this is going to end up with higher fees for me, more cost to the consumer?
That's a great question. I don't have a good answer for you, right? I mean, is bigger better? We could talk about that at great length. If you talk to JP Morgan Chase, they're going to tell you that bigger is better because they can cater to, you know, they don't have to make all their money from, you know, their bank fees.
Well, I
and
read
that
your
sort of
story.
thing.
You quoted somebody, I think it was Jay Ritter or somebody from University of Florida, who said bigger is better.
Yeah, but depending how you look at it. I'm not trying to opinionate on all of it.
One person's
I know
opinion,
there are, you know, but if you, so if you're a small bank in, you know, Michigan competing against JP Morgan Chase on technology, on loan pricing, you're in for a tough road, right? So there's something to be said for bigger in terms of scale.
I mean, Jamie Dimon, he's kind of tough. You've spoken to him before, right?
He is kind of tough. And what it means for fees, we will see. Matthew Monks, thank you so much for your time and congratulations on that story until the next Merger Monday. And joining us now for more perspective is Mihir Bhatia, Senior Consumer Finance Analyst at Bank of America. He has a buy rating on Capital One. Will you answer this question for us? If you merge Capital One and Discover, then does it necessarily mean higher fees? What does it mean for the consumer at the end of the day?
Yeah, so, firstly, thank you for having me. I kind of agree with Matthew, what he just said. You know, it's not exactly clear why it automatically means higher fees. Certainly, the companies will argue it doesn't. It makes the Discover network more of a competitor to Visa and MasterCard, which, you know, you could argue could help actually lower fees it could be a pro-competitive argument that you can make there, that, you know, you have more of a healthier network. You have a situation where Visa, MasterCard, there's only 4 networks. There's lots of credit card issuers. So if you can make the network side of the equation a lot more competitive, you know, you can make that argument that it could potentially lower fees. It remains to be seen as to why it would lead to higher fees.
To the extent that there are some skepticisms around this deal, you initially saw the stock of Capital One really dip on the news, now back in the green. But there are questions about the book value per share. There are questions about the regulatory hurdles at Discover. Is this a clear-cut deal, or do you see some challenges to meeting these goals?
Yeah, no, look, I mean, as you mentioned, you have 2 large issuers merging. It is going to draw interest. You're creating the largest credit card issuer by outstanding loans. So it's not surprising that there would be some regulatory scrutiny. There's also, as you mentioned, some idiosyncratic issues at Discover that Discover has been working through for the last year plus. But at the end of the day, right, you still have a market where you have effectively Capital One combined with Discover is still going to be just a little bit larger than JP Morgan.
Yeah. Well,
they're going to be competing with large issuers. It's hard for me to argue that they can do something monopolistic, anti-competitive, which would make it difficult for JP Morgan and Bank of America and Wells Fargo and Citi to compete with them. Right? This is still a very competitive market.
Mahir, I want to talk about the evolution, though, of Capital One and what this deal would mean should it actually be completed. I think a lot of us associate Capital One primarily with subprime borrowers, and I know they've tried to expand away from those roots. How much does Discover and sort of the stable of more prime consumers change the overall makeup of what Capital One's going to have on its balance sheet once this deal is done?
Yeah, no, that's a great question. And, really, I think what you really need to understand a little bit is the nature of Capital One's consumer credit card loans has changed over time. Currently, only about 30% of its book is what you would call subprime or sub 660 FICO at Capital One. At Discover, it's even less. It's around 20%. And the other piece of it is, that's at like a very high level. You're looking at, subprime versus prime 660. But if you think about where Capital One really specializes, it's in that near prime category and it's in the super prime category. It had a little bit of a barbell strategy. And Discover has historically fit nicely in the middle in the prime credit category. So what really, from a strategic fit perspective, look, the network, as Matthew said, is the reason for the deal, is the crown jewel, is the strategic asset. But even on the credit card side, there's a little bit of a hole, if you will, in the Capital One portfolio around that prime credit consumer. And this is where that fits in very nicely.
So the prime credit maybe becomes the icing on the cake if it is about the network, and that is they're going to be the primary driver for this acquisition and the primary creator of value. Is that a big part of the reason why we're seeing MasterCard sell off 3-4% today, Visa down a % or 2% today? How much business was Capital One shuttling through the Visa and MasterCard networks?
Yeah, so currently Capital One is a Visa and MasterCard issuer. On the credit card side, we believe it's 42% Visa, 58% MasterCard, I think. We published that in our note this morning. On the debit card side, it's mostly MasterCard. So all that volume that Capital One was doing is going to, over time, potentially move to Discover. Certainly what the company has said is the debit card volume is going to move over the next couple of years, starting in 2Q 2025. And the rest of it, and they're also going to move some credit card volume over. The number they've provided is 175 billion plus. That's out of 600 billion plus purchase volume that they do is going to move by 2027. So it remains to be seen. But I think it's fair to assume a significant portion will move over time.
All right, Mahir, great stuff. Mahir Bhatia over at Bank of America. A closer look at the deal of the day, maybe even the deal of the year. Capital One, Discover, the big tie-up there. And Shanali, you mentioned it earlier. Elizabeth Warren and some of the other folks in Washington already flapping their gums about this, saying they're ready to try to block this deal. I don't know if they'll be successful, but they'll certainly try.
Wink, nod, nod, apparently from the Fed and the OCC.
What do you think? Yeah, absolutely here. I mean, so this could be a big deal, and we should point out, you see the market reaction there, relatively positive, but I was kind of intrigued by the sell-off you're seeing at MasterCard and Visa. A lot of business going to shift away from that, and so it can be through now this Discover network. All right, I know you're into weight loss drugs and you're into snacks, so how about we mash that up into one discussion here? Weight loss drugs may be pressuring some of those food and snack brands, but the company behind Swiss Miss and Duncan Hines says it's well positioned to weather that storm. ConAgra shares having its best day since October. It's our stock of the hour, and it's up next right here on The Close on Bloomberg. All right, welcome back. It's time now for our stock of the hour. A closer look at ConAgra Brands. Shares rallying more than 4% on the day. Best day since October as the packaged food company gave a positive update on volumes and other trends. Abigail Doolittle joining us right now for more on this big stock move. We typically don't see these types of moves in a name like ConAgra. I think a lot of people think it's kind of a boring company, but they sell a lot of products that most of us enjoy.
They sell a ton of brands. If you go onto their website, Swiss Miss, Slim Jim, Healthy Choice, it goes on and on and on and on, Duncan Hines.
Wow.
But it's really the Healthy Choice that they highlighted. And
they highlighted that?
They did.
Okay.
Well, they talked about the fact that they are seeing positive trends because of Yes, you guessed it, the weight loss drugs. So my question is whether or not this is reality or if this is going to be some of the AI hype. But they did talk about the fact that they are seeing positive feedback from the weight loss drugs and the fact that they're single-serve meals from Healthy Choice, and they have some other brands, also frozen brands, that they saw up 8%. So they're also saying, this is really interesting, they're saying that their snacking is impacted in a positive way because people aren't going for chips and pretzels.
How do they make these correlations?
I don't know. That's why I'm saying that I'm a little skeptical
Okay, so Healthy
here.
Choice was up 8%. That's great, but do we know for sure that was because everyone's on Ozempic or Wegovy?
We don't, but that's what I'm saying. I think that they're throwing the Ozempic and the weight loss drug in there for that AI effect. But so instead of people snacking on pretzels and pop or potato chips, it's popcorn and Slim Jims.
And Slim Jims?
Yes. So is this really so healthy?
Out that Redenbacher's for Boom Chicka Pop.
I actually do love their popcorn. I will say their cheese popcorn is excellent. It's very salty.
Okay.
But nonetheless, I mean, the idea that that's so healthy for snacking, I don't know.
What's in a Slim Jim, by the way?
I don't want to know.
Oh, okay.
Abigail, we have to leave it there. Thank you so much for the update. Who knew that ConAgra would be benefiting? I have. I admit that I indeed have.
Okay. And you survived.
I survived,
Yeah.
but not by a large margin. Now, coming up next, we're going to get away from those snack foods. We're going to talk about technology. We're going to talk about Palo Alto Networks, Caesars Entertainment, and Toll Brothers out after the bell. More on what investors should watch for with Hank Smith, head of investment strategy over at Haverford Trust. Stick with us to the close. This is Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Shonali Bassick. The sell-off that we've been seeing in the markets over the last few days, continuing here at the start of this holiday shortened week. There is a lot of green on the screen, particularly when it comes to certain pockets of this market, but overall, a pretty big down day for the S&P, the NASDAQ, and the Russell.
It certainly is, and the SOX Semiconductor Index is feeling an even bigger sting there, Romaine, and we see some of the most loved stocks of the year finding some selling off today, maybe profit-taking, but certainly ahead of a big day for that semiconductor sector that is also leading losses in the S&P.
We're going to get some earnings after the bell, including from Caesars, so a closer look there at what's going on in the casino space, IFF, as well as Toll Brothers, also set to report, and Palo Alto Networks on the tech side as well. Big tech is dragging down the markets from record highs today. We had a chance to catch up a little bit earlier with David Sowerby over at Ancora Advisors, who says despite today's moves, this rally actually has more room to run.
By year end, I think there'll be still more upside. Just take the S&P 500 equal weighted. Since the end of 2021, it's up barely more than 2%. So the market had a great run last year, but that was a lot of catch up from the negative 2022. So I think there's more room to go.
David Sowerby speaking a little bit earlier here on the close. Hank Smith joining us right now to count down to the close, head of investment strategy over at Haverford Trust. And Hank, we were speaking with David earlier, and he really talked about his conviction that he does see some broadening out here in terms of what people are buying in this market, and that could be the salvation for additional gains in the broader market as we get deeper into the year. Do you agree?
Yes, I absolutely do. And whether it happens sooner or later, eventually it has to happen because you can't have 7 or 10 stocks drive a 500 stock index for a very long period of time. And there's real value in the S&P 490, if you want to call it, or otherwise the equal weight S&P 500, which is selling at a not very challenging 15.5 times earnings in an environment with inflation coming down. It's actually quite attractive.
I am curious as to maybe when we see a more full-on embrace of that, Hank. I think, as you know, the reason why it was 7 stocks and not the other 493 is because everyone thought we were headed off some sort of economic cliff. At least based on the data that we've gotten over the last few months, it appears we're going to avert that. Doesn't necessarily mean things aren't slowing down, but those worst-case scenarios seem to be off the table.
Yeah, and I would agree that a recession is a very, very low probability in 2024. And given that a bear market is also a very low probability because bear markets are almost always associated with recessions. And furthermore, you could see a broad pickup in earnings, because really we had flat S&P 500 earnings last year, and the year before it was down. So you have easy comps. You have strong margins. There's been a lot of cost cutting, as if we were in a recession last year. Of course, that never materialized. So we're very constructive with respect to the markets, although I might point out to your previous guest, we could have a flattish S&P 500, but the average stock does fairly well if, in fact, we have those magnificent seven, throw in the weight loss drugs, Lilly and Novo Nordisk, and make it the magnificent nine. If they pull back a little bit, that's going to bring the averages down because they're such a large part of the S&P 500. But overall, the market could do reasonably well this year.
Hank, barring any recession, you see cracks in the consumer, you see potentially higher for longer interest rates. What would create a little bit more of a correction when you think about the separate indices, NASDAQ 100 and S&P 500? NASDAQ 100 and S&P 500.
Well, two points. One is, in my 40 years in this business, through many cycles, I've learned never underestimate the United States consumer. It's in our DNA to spend, regardless of where we are in the business cycle. And so I'm not worried about the weaker retail sales that were reported last week. That's just one data point. I think the consumer still has healthy bank savings. I think there's still an unleashing of pent-up demand from the COVID period. And I'm not worried about so much increasing credit card debt or the lengthening of auto loans. I know those are all being cited. I think the consumer is still going to be powering this economy. And as far as a correction, look, all bull markets have corrections. They usually occur once a year. They're actually very healthy for the ongoing longevity of a bull market because it takes out some of the froth and excesses. I thought in the very beginning of the year, the first handful of trading days, we might be on our way to a correction, but of course, it quickly reversed itself. So I would not be terribly concerned about a correction or terribly concerned about some of the recent consumer data that you cited.
Hank, on days like today, are you finding buying opportunities, and where would they be?
Well, look, we'd like to see a pullback, if you will, from some of these companies that had parabolic moves, parabolic charts. Companies like Eli Lilly with their weight loss drug, or Meta that just instituted a dividend, and we only buy dividend-paying and dividend-growing companies. So all of a sudden, Meta is now in our universe, and put NVIDIA in that as well, that pays a very teeny dividend. And look, when you have a parabolic chart, there are always steep corrections. You just can't stay parabolic for any lengthy period of time. It just doesn't work that way. So I think some patience, let the market give you those opportunities.
Yeah, it certainly looks like we're starting to see maybe some of that consolidation that folks thought was more than warranted. Hank, gonna have to leave it there. Hank Smith, Head of Investment Strategy over at Haverford Trust, helping us count down to those closing bells. Just about 3 minutes to go here, Shonali, and we talk about whether this is sort of a consolidation phase, it is just going to be the reset for an additional rally, or if this is a more significant pullback as people start to reassess valuations. Yeah,
you have to wonder where the market goes from here. Something interesting, too, this was on a day where yields were falling.
Yeah.
And so you have to wonder whether that connection between higher yields and the market is breaking down, and whether valuations have just gone out of control.
And it gets to the broader point, too, about having better participation, right? Because when you have an NVIDIA and an Amazon and the other big Magnificent Seven stocks down, can the market actually find a way up without them? We've seen it on a couple days here and there, and I know the weightings don't necessarily favor it here, but when you get good results out of Walmart, you have Coca-Cola rallying 2%. Again, this seems to be a sign here that at least on the surface level, there's more there.
Certainly a day for the individual stock pickers, but if you're following the indices through those ETFs, doesn't feel as good. Yeah, absolutely here. The S&P now down about 0.7% off the lows of the day, but well off the highs as well. We are moving closer to those closing bells. Stick with us. We're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Sonali Basak. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar and Tim Stenovic in our radio booth as we welcome our audiences across all of our Bloomberg platforms. That includes radio, TV, our partnership with YouTube, Bloomberg Originals here on a day, well, Carol Massar, where we're seeing another decline here in the broader market. Still some concerns about valuation, still some concerns about how much is left in this rally.
Yeah, and a fair amount of concerns when it comes to what's NVIDIA going to say tomorrow when it reports, when we're still so excited about all things artificial intelligence. So you're seeing the stocks, when you look at it, some underperformance there based are compared to the other major equity averages. Right now, the stocks is down about 1.6%. And NVIDIA, I know, Tim, this is going to be one of your major decliners later, but it's really taking a big hit today.
Yeah, it is. We'll get to that in just a second. I want to take a step back.
Don't front run him, Carol.
I know.
Hey, that was a gift.
You
know, a little bit of a tease.
It would have been kind of
keep people around.
It would have been a little nuts had I not chosen NVIDIA as my first decliner, right, guys?
Yes.
Okay, so Jimmy Lee, the founder and CEO over at the Wealth Consulting Group, we just spoke to him, and this is a guy who said all last year you should be buying stocks. Don't have money in money markets. He said that was a fool's trade. He says the same thing this year. He says we're not going to see a recession. We're going to keep seeing the markets go higher. The Fed is going to cut rates this year. It's going to be a tailwind for risk assets, and it's a mistake to have cash on the sidelines right now. So he sees opportunities like this as buying opportunities, pullbacks like this, I should say.
We certainly are hearing the same thing from the likes of Hank Smith of Haverford, who is seeing even the likes of NVIDIA and other dividend payers like Meta pulling back and therefore becoming better candidates here to buy into because of those dividends.
All right, we get the closing bells here on this Tuesday afternoon. Remember, this is the first day of a holiday shortened week. Back-to-back gains on the S&P 500 flipping, well, to back-to-back losses. And S&P 500 down about 30 points or 0.6% here at the close, back below that 5,000 level. The Dow Jones Industrial Average lower by 63 points or about 0.2%, while the NASDAQ Composite is going to finish lower by about 0.9%. That's down by about 145 points. But the big decliner on the day, that's the Russell 2000, a loss of about 1.5%.
All right, so let's get to the flip side, some individual gainers, if I may, in today's session. And you've got Discover Financial. We know the reasons why, right? Up just off its highs of the session, up almost 13% in today's trade. Capital One Financial, of course, that deal that Bloomberg broke to buy Discover Financial, a $35 billion all-stock deal. It's going to create the largest U.S. credit card company by loan volume. So big deal, and no surprise as Discover being the target to see it really outperforming and rallying in a big way. Got to get to Walmart. Another story, some M&A action there as well. Walmart finishing the day with about a gain of about 3.25% off its highs, moving the most since 2022 of November, topping earnings estimates in the fourth quarter, also confirming reports that it is buying smart TV maker Vizio for about $2.3 billion. Walmart did put out softer guidance, but nonetheless, some outperformance. Should we get to some earnings?
Yeah, if you like earnings, Carol Massar,
I do.
You're going to get them right now. Caesars Entertainment crossing the wire here. Net revenue coming in the most recent quarter on a same-store basis, $2.83 billion. The street was looking for 2.85, so a modest miss here on the top line. As for the bottom line here, they had a 4Q loss per share of about 34 cents. Not quite sure what the comparison is on that here, but overall, you're looking at about a 34 cents loss in the most recent quarter on $2.83 billion in revenue. EBITDA in the quarter, $930 million. The street was looking for 945.
A little more commentary on Caesars here. The chief executive officer of Caesars, Tom Reeg, really citing here the progress being made in the digital business there. Really, of course, you're saying we are seeing a bit of a miss in total earnings. So management shifting you to look at those digital numbers here, a 78% increase to approximately $1 billion. Of course, all shifting online.
Yeah, look at that. Over $700 million improvement in this segment's adjusted EBITDA. Digital net revenues approximately $1.0 billion, Sonali.
Yeah, I also want to bring you some more earnings here coming coming in from Chesapeake as well, coming in after the bell. We're seeing adjusted earnings per share hit at a higher than estimated number at 1.31, $1.31. The estimate was 71 cents. Of course, the energy industry has been of high interest to investors in this era. Major deal-making moment for the industry here. We are seeing them beat estimates according to what Wall Street had projected for earnings per share.
Yeah, so seeing what a little bit of movement we saw in the aftermarket here when it comes to Chesapeake, just actually seeing it unchanged at this point. But, you know, the energy space, no pun intended, has been on fire a little bit in terms of some of the consolidation. But this one, year to date, too, just little changed, remained just up about 1% here.
Absolutely. And I mean, it's kind of come divorce, I think, from some of the moves that we've been seeing
Agreed.
in actual energy prices themselves, and maybe for a good reason. And you mentioned all that M&A, of course, that has been on fire, as you just said, and maybe that does continue.
Yeah, to that point, Nick Dell'Osso, the president and CEO of Chesapeake, saying that the strategic combination with Southwestern will make our future outlook even stronger, extending America's energy reach by positioning us to deliver more reliable, affordable, lower carbon energy to markets in need. The company is also forming the first U.S. independent that can truly compete on a global scale. It says that it's going to redefine the natural gas producer to the benefit of shareholders and energy customers alike.
All right, just going back to Caesars, if we may. We're still waiting for some others. Keep in mind, too, about 4:30, we're going to get a read on the housing sector with Toll Brothers. But Caesars continuing to be under pressure here in the aftermarket, down about 3.4%. We broke down their earnings earlier of that fourth quarter same-store adjusted EBITDA. That was a slight miss, $930 million, 944.5. We talked about, you know, increasingly for these companies, these gambling companies, the importance of digital. But nonetheless, we're seeing some disappointment here. Right?
Well, the digital was doing great. I mean,
I
think it was up 28% in the most recent quarter. Unfortunately, that
not
makes
enough,
up
right?
a small percentage of their revenue. I think total revenue, it's only like what, less than 10% or something like that.
Yeah, and it's interesting to the point you're making there. We have Las Vegas same-store revenue missing expectations according to MODL estimates that we're seeing on the Bloomberg terminal here. So the digital's not making up for those core markets.
I have a question, though. How do they find that balance? So, I mean, I was just out in Vegas, and I mean, obviously still a big destination for those folks who want to gamble. But you're reminded pretty quickly, just from all the ads out there, that I actually don't need to be there. I mean, if you have a telephone and you're in the state that allows it, I don't need to go to Vegas or Atlantic City or anywhere else.
You need to be there to see. You need to be there to see U2 at the Sphere. You need to be there to see Adele. Yeah. You need to be there to eat the food. Okay. And so that's. I think that's a big part of it. To the digital side, though, I do think.
But is Adele there? I mean, I saw her at the weekend at the All-Star game, and apparently she doesn't like performing.
She was there a few months ago. I know. But
all right.
Yeah, she was. I saw a big sign for her performing, but she wasn't actually singing.
You want to go to some other earnings that are out?
Palo Alto Networks' Carol Masser is crossing the wire right now, so let's get right to it. Those shares moving lower by about 13% here in after hours trading. In the most recent quarter, its fiscal second quarter, EPS came in at $1.46 a share. Revenue came in at $2 billion. Both of those were a beat. However, here's your guidance going forward. For the third quarter, fiscal third quarter, the company sees adjusted EPS at $1.24 to $1.26 and revenue at $1.95 to $1.98 billion. Both of those would be below what the street was looking for on average. For on a full year basis, the company says adjusted EPS $5.45 to $5.55 here, and full year revenue at $7.95 to $8 billion even. At the top end of that range, that's below the bottom end of the range that it had been given before.
Yeah, the full year numbers certainly coming in well below estimates. You're seeing the shares now drop between almost 12% and more than 12%, almost 13% after market, after reporting those figures. And to your point here, revenue softly above estimates, but not all forms of its revenue. Subscription and support revenue came in below estimates, and therefore you have to wonder about business spending in this environment, Romain.
We've seen, I'm sorry, go ahead, but we've seen this with some of the other cybersecurity companies here, and there's been a lot of talk as to the health of these companies, and also the migration, the idea that a lot of people would rather just, say, deal with the Microsoft or deal with an Alphabet or deal with somebody and get sort of an all-in-one solution rather than having to farm it out to smaller companies.
It's also a company that's been up big time this year. It's up more than, 20%. I think it's up about 24% year to date. So maybe some really high expectations were built in. But if you look at that third quarter forecast, whether it's billings, whether it's adjusted EPS or it's revenue, I mean, they're really reining in the numbers and disappointing on all three fronts.
Yeah, and I'm not seeing that reflected at all in the commentary, at least in the press release at this point. The company's CEO and also chairman saying that the leadership goes across all three of the platforms, and growing cross-platform adoption puts us in a strong and unique position. So no acknowledgement of the outlook that is coming in below estimates.
It'll be interesting to see how investors digest because obviously this is a knee-jerk reaction, but you're still talking about a company growing revenue at double-digit percentages here, both on the quarter and the year. And while that's below those 30-40% growth rates that I think some people have gotten used to, I mean, 20% growth, which is what they had in the most recent quarter, that's pretty good.
And they say the buzzword right up high in their statement, of course. They're
AI or
focusing on their AI leadership strategy. There's three buzzwords for you just at once.
They got it in there. They got it in there. But investors certainly not impressed here. Palo Alto down about 13% here in the aftermarket. All right, guys. I know we're getting to the tail end of earnings, but nonetheless, a fast and furious dump here.
Is there a big one tomorrow? Is there a big one tomorrow after the bell?
Perhaps.
Big one.
Okay. Yeah. NVIDIA.
We'll be on it. All right. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. Guys, we will see you again. We call it Beyond the Bell. We'll see you again, same time, same place, tomorrow.
All right, stick with us. Coming up after the break, an exclusive conversation with ARC House managing partner about the firm seeking a majority on Macy's board. That conversation coming up after the break. This is Bloomberg.
Welcome back to The Close. I'm Shonali Basak alongside Romaine Bostick. And now that we have the market day closed on the day, I want to look ahead for a moment here because the big day tomorrow is NVIDIA. And this was one of the big losers today in the market, really dragging down the SOX Semiconductor Index, the Philadelphia Semiconductor Index, as well as a lot of those big tech names. But the options price movement here could imply an 11% move either way when you look at the put options and call options put together here. And that would mark one of the largest swings you have seen after an earnings report for a single stock. So a lot of eyes on NVIDIA into tomorrow. I also want to talk about another thing that we've been watching very closely here, and this is WIRP Go on the Bloomberg terminal. After the market is NVIDIA tomorrow, but during the market is Fed minutes tomorrow. And we see the likelihood of Fed rate cuts really being swept out of the early part of the year, according to Fed futures trading. You look at March, chances are dimming. You look at May, chances are less than 30%, according to investors. But when you look at June, the chances are still above 60% in the market. We'll see if that conviction holds when we see the minutes tomorrow. And lastly, I want to talk about an activist, because this has been the story of the year. Activists coming to the market in the middle of a choppy market. And we're talking about Macy's in particular, strength of the consumer, but also commercial real estate. We look at the activists who are targeting Macy's, and this is really what they see in front of them here. They see almost 500 Macy's stores. They see 32 Bloomingdale's locations, and they see more than 150 Mercury beauty stores. Now, the question, Romaine, becomes, what do they do with all of that land?
All right. Well, the battle is starting to heat up, and we learned a little bit earlier that ARC House management had nominated 9 people for positions on Macy's boards a month after ARC House made that $5.8 billion takeover bid, a bid that Macy's promptly rejected. Crystal C. joining us right now, who covers the consumer retail M&A for us here at Bloomberg. And Crystal, I mean, give us a sense here of where we stand. I feel like so many people have either kicked the tires or, I guess, tried to sort of, shake Macy's management to do something and do something different. How many are circling right now?
Yeah, I mean, ARC House is one of them, and it's not the first time that someone is trying to shake up a big retailer. If you remember, Kohl's was in a very similar situation where they saw a bidding group franchise was there trying to take the company private, and every time you have a deal like that, the name Sycamore is always getting thrown around as someone who could take the company private. The thing about retailer is that obviously they're struggling. They've been challenged by e-commerce, and brick and mortar is facing a lot of challenges. And there is an argument for taking this company private, and so it's not subject to markets quarter-to-quarter update. So there is an argument for that. And in this particular case, ARC House was partnered with an investment firm on its bid, but it's also making a push to nominate 9 directors.
Now, how do you see the potential for Macy's to really push back here? It's something we've all been talking about so much, that companies have felt emboldened to push back. But activists have typically won board seats when they're targeting an embattled company like this. Does Macy's have a chance?
So Macy's taking an unusually aggressive move compared to other companies that are subject to activist treatments. It's not just because it is an activist, it's also a takeover bid. When you have a hostile bid, you probably have a slightly different tone compared to just an activist canvas showing up. So whether they will push back, whether Arkhouse will win board seat, we will see. And I'm sure Macy will do everything they can to keep control of this company.
All right. Well, we keep talking about Arkhouse as if they aren't here. Crystal, great to have you. Crystal C., who covers this for us here at Bloomberg. And well, let's get right to it. An exclusive interview right now with Gabrielle Kahane, managing partner over at Arkhouse, joining us here at Studio 2 at Bloomberg. Gav, great to have you.
Great to see you, Romain.
All right, let's get right to it here. I mean, 9 board seats, that's a lot. I mean, most people come to the table with maybe 1 or 2. Why 9? And more importantly, if you get them or even get half of them, what do you expect?
Yeah, sure. So, I think 9 is really driven by the company's size or the existing incumbent directors. There are 14. So to gain a majority of the board, we need to nominate at least 8. So our expectation is really that for whatever reason, management and the board have not sincerely engaged with us to date. And the only way that we can ensure that we unlock the value for our sizable economic position that we have and for other shareholders is by turning over that slate.
So you turn over that slate. I mean, what's the elevator pitch for what you do after that? What unlocks that value?
Explore strategic alternatives. Like, obviously, our preference as, an interested buyer is that they sell to us. But our expectation, of course, is that they should run a process to determine what is in the best interest of all shareholders. My strongly held view is I think we have a very strong group assembled to buy this company at a very big premium, and I think we stand the chance to win.
A very big premium, but what do you do with it then? I mean, or let me rephrase that. What do you do differently than what the current management is doing right now?
Well, we could definitely speak to that a bit. I think it's important for shareholders to know that they don't need to worry, because once we close, it's out of their hands. They've taken that profit and gone on to invest in other things. That said, it's of no surprise to you, Romain, I'm sure, that the company, and you referenced it moments earlier, the company holds a substantial amount of real estate on balance sheet that the company has just done an abysmal job at realizing on behalf of shareholders.
There's more to be had of this real estate play here, but we've been talking so much about Macy's pushback as well. How much of the company do you currently own? How much stake have you amassed, and how much power does that give you in winning these board seats?
So we have a 4.4% economic exposure to the company right now, and our strong beseechment to other shareholders, and we've gotten very positive unsolicited inbound so far, is to reach out to management as we have and implore them to provide us diligence and engage with us to at least determine if there's a deal to be had for the benefit of all shareholders.
At $5.8 billion or more than that?
Right.
So $5.8 billion represents the equity portion of the transaction. In other words, the market cap plus premium.
Yeah.
But there's also debt on balance sheet of the company. So far we've offered $21 a share. We've stated very explicitly to both publicly and to the company privately on numerous occasions that we have a lot of conviction and optimism that we can increase our offer if we're given even just limited diligence, and the company's been resistant to providing even that.
Yeah, that was going to be my next question. You've said that you could increase this offer. At what point would you increase it, and how much would you increase it by?
Listen, we're hopeful that we can, and that we will, but we need diligence. There's just there's only so much we know definitively about the company's assets. There's opacity into specific things that we need as buyer to figure out exactly how much we can pay.
What?
We don't even know store-by-store profitability, right? We're guessing at that. We don't know tax basis on the real estate. We don't have any other relevant, information on performance that's absolutely critical to crossing our T's and dotting our I's.
What is the plan there to then maybe close some stores moving forward? Is the idea here to sell some of the real estate and get out of some of the existing locations?
Yeah, certainly. I think there's some of that should and probably will be executed on. But in our view, this is really a Macy's forward plan. In other words, they own 100 million square feet of real estate. That real estate is incredibly valuable, largely because it's occupied by a great retailer. A retailer, nonetheless, and a department store. And of course, they face plenty of headwinds, like every other department store. But we think that they should be, the most resilient of the bunch and the one that lasts the longest, but are fearful that they won't in the public domain.
But that real estate has been a ballast for the company, particularly given how much the core retail business has struggled in recent years. And I know there's some questions, at least as a public company, that if you were to separate those, what does that leave investors? And I know taking it private, that's a whole different dynamic. But there is a broader question, and you understand. I mean, Macy's is more than just Macy's. It is probably one of the ultimate brand names. It is so identifiable. And anything you do with it is going to come under a tremendous amount of scrutiny, whether it's from a Wall Street perspective or just from that sort of from the heart consumer perspective.
Yeah, absolutely. I entirely agree with you. We are not specifically advocating for a spin-off of the real estate. Though I would say that holding real estate on balance sheet, especially when you only have one director with any real estate track record, and by the way, that's not from us, that's from the company's own own perspective in terms of strengths of their director candidates, of their incumbent directors, is a bad idea. It's a bad idea to own real estate and to try and manage and asset manage and profit from real estate when you're not a real estate investor.
Activists certainly getting involved very significantly in the retail sector. Gabrielle Kahane, we thank you so much for your time. Partner at ARC House, targeting Macy's. Now, coming up, we're going to talk more about Walmart, the consumer sector. Walmart hitting a record high today after a strong outlook. We'll dive into the results next with Corey Tarlow from Jefferies. This is The Close. Stick with us on Bloomberg.
All right, welcome back. Let's take a look at Walmart. The share is having their best day in, well, almost a couple of years here, closing at a record high. This after reporting earnings that topped estimates. Corey Tarlow joining us right now. He's Senior Vice President of Equity Research over at Jefferies. He has a buy rating on Walmart. Corey, I want to get your just sort of knee-jerk reaction to the report, because I don't think anyone would deny it was a great report, definitely for the quarter. But there was some caution in the guidance, and particularly in the commentary. How pleased were you with what you heard?
Very pleased. So I'd say across three main categories that we look at, sales, margin, and outlook, each of them really checked a box that we had expected that would largely be better than what consensus was. So first on sales, for the Walmart US business, the street was actually looking for about a 3% same-store sales growth metric. Our numbers were at 4%. And so they had printed around 4%, which is really great to see, and it was also ahead of consensus, and you saw the stock react positively to that. Second aspect was gross margins. Margins were better by about 40 basis points year over year on lower markdowns. It's really driven by better inventory. And we've seen this now for 3 quarters in a row. When retailers are better at managing inventory, they can drive better margins. And then lastly, on the outlook, Walmart, after the issues that it had over the last couple of years with inventory and COVID, really, I think, looked to set a beat and raise type cadence. And what did they do the last year? Well, they beat and raise every single quarter.
The overall business looks healthy. There was a lot of discussion about the e-commerce side of the business, which is, from a revenue perspective, certainly healthy. From a profitability perspective, not quite.
Yes, that's correct. So one of the things I would note about the e-commerce business is that it's just grown exponentially. So in this last quarter, it grew about 20%. And 20% might not seem all that impressive to you on the surface, but 20% is actually on a base of close to now run rating at $100 billion. And for perspective, in 2018, that business was $25 billion. So it's quadrupled in a matter of 6 years.
It's kind of easy if you're Walmart sitting on top of a mountain saying the consumer's softening, but we're generally protected from it. If you see Walmart as a giant making those kinds of comments of any sort of weakness in the consumer, who does it actually start to impact?
Well, a lot of the discussion around the consumer has been that the consumer's been largely resilient. And I think it's been mostly driven, according to the Walmart management team, by the strong job market that we've had. And so while the consumer is resilient, what we are seeing is a shift toward value. And not only are you shifting more toward value-oriented retailers, but a shift within those retailers toward value-oriented brands like private label. And so we've seen private label really gain meaningful traction over the last 12 and 24 months. And this, honestly, for retailers like Walmart or Costco, actually comes with a slightly modest profit benefit.
You know, in addition to earnings, there was that Vizio acquisition announced as well. As somebody following the stock, what does that even mean to you for them to be plowing another $2 billion into a TV company?
Right. I think it's really about the advertising business when it comes to this acquisition. What the unique aspect that Walmart has is that it's data. It processes millions, if not billions. I think the number is posted on their website, like 40 petabytes of data a day, which is an insane amount of data. So using that data with Vizio to now service not only the customer at a more data-driven, having more accurate metrics around what the customer wants and needs, but also parlaying that with what the advertisers want and need. And so it does become a very nice potential acquisition for Walmart.
Future of Walmart, tech company.
I don't know what petabytes are, but that sounds big.
Thank you to Corley Tarlow from Jefferies for keeping an eye on that Walmart story for us. Still ahead, a conversation with a man of many hats in the world of sports and restaurants. We'll talk to Tillman Fertitta about his newest Miami locations. Stick with us. This is Bloomberg.
Welcome back to Bloomberg Markets to Close. Keeping an eye on what's been going on in the earnings season. Now getting results of Toll Brothers crossing the wire right now. The big home builder here in the United States reporting fiscal first quarter numbers here that at least across the board appear to be a beat. EPS coming in at $2.25 a share. The street was looking for $1.78. Total home sales in the quarter also beating at 1,927 here. And the company providing some pretty decent guidance going forward here, Shonali. Second quarter adjusted home sales looking for gross margin that could come in right on the nose at about 27.6, and deliveries that might also come in above street estimates, 2,400 to 2,500. That's the range they're giving. The street on average was looking for 24.94. Those shares are moving higher in after hours trading. We're going to get back to that story and a closer look at the home building sector in just a second. But we want to focus a little bit here on sports, on gambling, and restaurants. Industries like tech and crypto have flocked to Miami in recent years, but the city remains a hotbed for travel and hospitality. Businessman Tillman Fertitta is expanding in the city, opening up one of his Maestro's restaurants there, and pleased to say that he's joining us now for a look at the state of hospitality and ownership. Tillman joining us right now. Of course, he is the owner of Landry's, Golden Nugget Casinos, the Washington Commanders, and quite a few other things that I'm forgetting. Tillman, this is only a 2-hour show, so we can't list all your accomplishments. But
I know, but Josh Harris is going to really be upset about the Washington Commanders. Let's try the Houston Rockets.
I caught that here, and my apologies for that here. The Houston Rockets, the Washington Commanders, a fine club. But Tillman, let's start off here. I do want to start off in the restaurant space here. That's what a lot of people know you for here. That empire has been expanding, but there's been a lot of questions, a lot of concerns here about how much expansion is left in that tank.
Well, from a restaurant standpoint, you know, our population continues to grow, and restaurants close and new restaurants open up. And as you watched it for the last 30 years, the people that change and change with what the consumer wants are going to be successful, and the people that don't change are going to close. And you always have enough people that don't change, so you don't ever have to worry about being overpopulated with restaurants.
Certainly not. When it comes to demand, there's the demand side of it, but there's also sort of your own inputs here, labor costs and food costs and things like that, things that got disrupted during the pandemic. Are they back to normal, Tillman?
Well, they're back to normal, but your cost is so much more today. And people try to understand, well, why does it cost so much to eat out today? What they don't understand is that our food cost is 20% more than it was 5 years ago, and our labor cost is 20 to 25% more than it was. And that's why you pay that you paid $30 for something, you paid $40 for it today, is to make up for that. And that's the way the supply chain is from a people standpoint and a cost standpoint. It's electricity, it's labor, it's occupancy, it's all the above, and that's just the new cost in America. But at the same time, everybody makes a lot more money today than they did 5 years ago.
Well, what does this mean for how consumers are spending? When you look at kind of the luxury high end, we're hearing a lot of anecdotal evidence about the sticky spending you're seeing, particularly on restaurants and travel. But do you see a bifurcation on Americans who may feel a lot more stung by the weight of inflation today?
100%, okay? Like, let me give you an example. 21 and 22 were the greatest years that everybody had in high-end retail, high-end restaurants, casinos, okay? In 23, without all that government trillions of dollars out there with that same consumer, you've gone back to a normality to your high-end restaurants. Now, your lower casual in dining, you know, say my Rainforest, Bubba Gump, Saltgrass Steakhouse, even your chart houses and those type of concepts, but your Catch, your Mastros, your Martins, your Del Frisco's, your high-end steakhouses are not doing the business that they were doing in 21 and 22. We're more back to the 19 levels and the early 20 levels.
When we think about how people are changing the way they spend, let's move from restaurants to gaming for a second here. You have Caesars coming out, really disappointing investors here on the Vegas numbers that they're putting out there, but really highlighting digital. A lot of talk about online gaming, DraftKings after the Super Bowl, of which, of course, you have a large stake after that Golden Nugget deal. How do you think about how consumers are going to be spending on gaming and betting moving forward after this pandemic era?
Well, I think they're going to continue enjoying it, and everybody loves the entertainment of gaming. The national gaming numbers were like $62 billion for gaming companies last year, which is huge. But you've got to remember, okay, we all in 21 and 22, because our margins were so high, because we couldn't get employees, and also there was so much extra money out there, we all had monstrous numbers. And it started to come down a little bit in 23, and it's all this regional gaming it's not going to be what it was in 21 and 22, and that's why it's starting to slowly come down toward normality. But at the same time, we're all doing a lot more than we did in 19 and of course 20. Let's not even talk about 20. It's a year that didn't exist.
Yeah.
But you're not going to do 21 and 22 numbers anymore. It's not going to happen. And so when people say, oh my gosh, Caesars, isn't doing those numbers in their regional casinos, compare them to 19. Do not compare them to 21 and 22.
Yeah.
Don't compare any company when it comes to the consumer of what their 21 and 22 numbers were, or you're making a mistake and you're going to be disappointed.
Yeah, I think a lot of investors have already picked up on that, Tillman. I do want to pivot to sports, and I once again want to offer our apologies to you. Obviously, owner of the Houston Rockets. You have obviously, yeah, and we can laugh too. I mean, I was just watching the All-Star game, and there's been a lot of talk about the new NBA contract. There's been a lot of talk about the decline of regional sports networks, and I'm just wondering where you see the revenue streams for sports coming from longer term here. What do those contracts start to look like?
Well, the players and the owners are in the same boat. Okay. We're partners. They get X amount of our basketball revenue and our revenue related to basketball and anything to do with it. And so we're all in this together. And if we do want to continue to grow the value of these teams, we've got to figure out television and streaming. But at the same time, all these companies that televise us have a right to make money also.
Yeah.
And so I understand what Fox and ESPN and Discovery are doing, but and trying to shut everybody else out and trying to make it work for all of us and themselves. And so I'm very sympathetic, But I don't think I know where it's going. I don't think anybody knows where it's going. But when the NFL contracts are up in 30 with the networks, things are going to definitely change.
Right.
But I can tell you this, people want to watch games on television. They do not want to watch them on their phone. Okay.
Well, I don't know. I'll push back on that, Tillman. I mean, we've seen a lot of folks, particularly younger generations, that are much more comfortable watching it on, their mobile devices rather than on the couch in front of the actual TV that maybe some of us are used to here. I mean, how do you adapt for a world where you are going to have just a much larger percent of the population that, let's just say, wants an alternative?
Well, let's say this. You could still stream it to your TV. But I know when I have to watch a game on my phone, and when my kids who are very into the Rockets are watching it, we want to watch it on a big screen TV. Now, I can't tell you, but I know our group of friends, they're young friends, but I guess we're going to do what we have to do, but I still don't ever see those big televisions in all of our homes and businesses going empty. Okay, that's why bars, restaurants, everybody have big TVs in their establishments today, because sports is religion. And the one thing that we all have in common is watching our sports teams.
Do you think, though, that the cable networks and the big networks will at least give a little on that when you guys go into negotiations? Because it's going to be a topic that comes up whether people really want it or not. There has to be some component where there's a balance between those two. And I'm wondering, how much give do you think you're going to see there?
I think there's going to definitely be give, but I also think you're going to always have the ability to stream it on your TV. And it's amazing, that when you had Netflix and everybody, and then all of a sudden now the TVs come out and you can get it right off of your TV, that you don't even need the box. Okay, so new technology is going to keep up with whatever the companies need to do to be successful, and it's going to become part of our everyday life. But when you start talking about what's happening now with the streaming, we will adjust to it and we will adapt to it. But let's all be honest, it was much more difficult to watch an NFL game this year when you were used to on DirecTV, when you had the NFL ticket just to go into another channel instead of having to go to a whole nother system in YouTube this year. So we all had to learn a lesson this year that it wasn't quite as easy.
Tillman Fertitta, we thank you so much for your time. That, of course, is the owner of Landry's and the Houston Rockets and the Golden Nugget Casinos. We appreciate your view of the world. Now, we want to bring you some breaking news here. Citigroup raises CEO Jane Fraser's pay to 6.1% to $26 million for 2023. We want to put that into comparison for you here a little bit. We did see other CEOs, such as that of Goldman Sachs, be raised much higher, 24% over at Goldman to $31 million. You have the Citigroup board really citing some factors here. At Citigroup, they cite the relative share performance and also the transformational change that Ms. Fraser has been making over at Citigroup. That includes the exit of 14 international consumer markets and the most consequential set of changes announced in Citigroup's organizational and management model. Remember, Citigroup shares in 2023 did lag some of its rivals, including Goldman Sachs, JP Morgan, and Morgan Stanley. So we'll keep an eye on all of that executive pay for you. And in the meantime, we're going to look at now how the markets closed here on the day. Romaine, we have seen a leg lower in the S&P 500 and the NASDAQ 100. We saw tech-heavy indices really taking a bit of a beating today. The SOX Semiconductor Index closing down more than 1.5% on the day. The NASDAQ 100 down almost 0.8%, and the S&P 500 down 0.6%. We saw the two-year yields end the day around 461 on the day, holding steady there, about 2 basis points lower on the day. You saw 5 basis points lower earlier on the day, but holding above that 460 mark quite meaningfully.
Yeah, the catalyst to the downside here on the day, both in terms of the yields and in terms of equity prices. That could flip tomorrow with Fed minutes out around 2 p.m. Eastern time and big earnings after the bell with NVIDIA. Meanwhile, here on this Tuesday, when we return, we're going to take a look back on this day and the nation's original communications network, the U.S. Postal Service. And we're going to leave you with the question before we go to break: how much revenue does the Postal Office generate each year? The answer when we come back. This is Bloomberg.
close eye on that housing market. We're going to get back to the latest results from Toll Brothers and what it means for the state of the U.S. housing market. Joining us now is Bloomberg's Nora Melinda. We did see Toll Brothers beat expectations on a couple fronts here. What was expected? What was surprising from these results?
Yeah, this was a really pretty much upbeat report across the board. We're seeing a beat when it comes to EPS, gross margin, which is a key metric that we use for home builders, as well as revenue. So it really is seeing some progress there. And this is all in the midst, especially as we look at the last quarter. In the fourth quarter, we saw a lot of expectations really high when it comes from the trader perspective. And some of these home builders weren't actually meeting it. And one of those metrics that we're thinking about is incentives specifically.
Yeah.
And so while we saw a lot of those home builders actually raising their expectations when it comes to incentives, Toll Brothers has actually been pretty good in terms of bringing down their incentives and pulling back. So really great as we're looking forward.
So that helps the bottom line here, but the growth, the top line, that still remains, the demand's there?
Exactly.
Yeah.
So, I think that's really what we're seeing across the space is whether or not we're actually going to have these home builders still seeing that pricing power that we're looking for. That's what we're thinking about as we head into spring selling season here.
All right, Nora Melinda, who covers the housing sector for us. Quick breakdown here of the earnings that we got out of Toll Brothers. Those shares moving higher here in after hours trading by about 3%. Tom Shapiro joining us right now to keep the conversation going. President, founder, and chief investment officer at the global real estate firm GTIS Partners. And Tom, I know Toll Brothers sometimes is kind of its own story here, but when you look at their results and you look at their performance, is that representative of the broader housing market overall, home builder market, I should say?
Yeah, absolutely. Toll is an outstanding home builder, and Doug Yearley has done a great job running that business. We're partners with them on a very large project in Houston. We're just to give you anecdotal evidence, we were doing about 5 per month, January, February of 2023 per housing sales per community per month, and we're doing 7 right now. So we're seeing really good home builder sales, and it's not at all surprising. And it's really a sale, basically a story of 2 different cities here. You have existing home sales down 6%, lowest level in 30 years, but home prices still up 4% because there's just no one selling their home. You have almost 80% of people have mortgages under 5%. And so people don't want to give up those mortgages, so they're locked in. And the home builders are pulling out all their stops to try to attract home buyers. Mm-hmm. They're using buy downs for rates. They have really good new product. Toll and all the other major home builders are using a lot of different techniques and ads to their product to make them much more attractive to the average buyer. And basically existing home inventory is just very shallow right now. There's only 1.1 million homes on the market right now of existing, and that's in comparison to about 2.27, which is the average million homes.
Right.
So
Tom,
there's very little on the market.
I'm very curious here. You look at the Toll Brothers numbers here and them beating expectations for the year on deliveries. And what comes to mind here is whether there's a bifurcation in the market. Is there kind of a cutoff price point here at which it gets easier or harder to buy a home?
You'd think so, but interestingly, we do a lot of entry-level homes, and those homes are selling extremely well, in addition to the higher-end homes. And again, a lot of it has to do with the home builders are spending money on rate buy-downs, so they're getting the mortgages, 5% or under for new home buyers, as opposed to 7%, and it's almost 8% at the top of the market. So with those bag of tricks, it's actually really helping home sales. So we're seeing it, across our portfolio right now. We're not just seeing it on the higher end.
Now, at what point do things start to get easier for the buyer? You saw that kind of relief in the mortgage market at the end of last year. Then you saw a tick higher once again, and that was before the rate expectations really changed in the market once again in the last week or so. So is there a worry here that higher for longer could break the market further?
Well, it hasn't to date. We've seen really good home builder sales throughout this entire rate increases over the last couple of years. And I think it's a lot of why we didn't have problems like we did in, going to the GFC. We just never had the supply we had because of this lock-in effect that people just aren't putting their homes on the market. So we have very, very little inventory. So that's really helping. Certainly, it doesn't seem like rates are going to cut quite as quickly as they were, but rates are still down about 1% from the top. We're still at sort of a 20-year high for the mortgages, and people are still buying. And I think we're going to continue to see that, even though affordability is bad. For the first time, we did see wage growth to be greater than home price appreciation. And we hope to see that in 2024. But it's still not very affordable to buy a home, but people are still stretching to do it. And again, with the home builders with their toolbox of being able to buy down mortgages, it's really helping to move their inventory.
All right, Tom, great stuff. Tom Shapiro, President, Founder, and Chief Investment Officer over at GTIS Partners. A closer look at Toll Brothers. Those shares moving higher here in after hours trading, up by about 3%. We should point out some of the other big movers here in after hours trading. A big drop right now on Palo Alto Networks, down about 17% here in after hours trading. Some of the other big names also moving lower, including Zscaler and some of the other cybersecurity stocks. We're going to set you up for the big market moving events tomorrow, and it includes a big one. Stick with us. This is The Close on Bloomberg. One of the big market moving events potentially tomorrow is going to be NVIDIA earnings set to drop after the bell tomorrow. Joining us right now for a preview is Kujan Subani on our San Francisco office, Bloomberg Intelligence's senior semiconductors analyst. And Kujan, I'm not sure where to start here. Expectations are high, but so too is revenue. We're looking at $20 billion in revenue. That's more than double what this company reported just, 3 quarters ago?
Yeah, once again, we expect a solid report and guide from this company. Supply has come in significantly. Lead times have shrunk, but demand continues to outpace supply, hence increasing our odds of a beat.
When you think about just how much the stock has run up, how high the expectations are, how much do they have to show investors to create this momentum?
I mean, look, we do expect that the growth going in 25 will normalize, and we don't expect to see the same magnitude of beats that we saw last year, right? Just because of the law of large numbers and the higher visibility we have. I think the key focus will be commentary that sort of solidifies the 25 and 26 numbers, as there have been rising concerns around China restrictions, its largest customers designing their own chip. So if the company can provide more optimistic commentary that this demand rally is just beginning, that would be great.
All right, Kujan Subani there at Bloomberg Intelligence. A nice preview of what we could potentially expect tomorrow when we get NVIDIA's earnings. We know no matter what they report, it's going to be a lot of volatility around that stock. A few other big market moving events tomorrow, and that starts with the FOMC minutes at 2 p.m. Eastern.
Yeah, a lot of commentary around that, a lot of questions around what it means. We saw rates, yields reducing today, lower today going into tomorrow, but let's see if that holds.
We're also going to get the G20 foreign ministers are going to be meeting, and they got a lot to talk about.
Certainly a lot of turmoil in the world, and let's see if that finally feeds into markets that are already on fragile footing.
And then let's get back to earnings here in the morning. We got a couple, I think it's like HSBC, Wingstop, I know your favorite, also reports as well. But let's not kid ourselves. Aftermarket is where most of the meat is going to be.
Wingstop, Carvana, you have to look at these EV stocks as well with so much pricing pressure in the EV industry, Rivian, Lucid, and that's all alongside what we've seen tomorrow aftermarket with NVIDIA as well. But then there's Marathon too, some energy love for you as well, and consumer with Etsy. You got a little taste of everything there.
Yeah, and I was looking at NVIDIA and what's been going on in the options market, an implied move of about 11% up or down no matter what happens here. Certainly a lot of folks on pins and needles. Join us tomorrow. We're going to have full coverage of all of those earnings and more. In the meantime, stick around. Full politics coverage coming up after the break with Balance of Power right here on Bloomberg.